Okay, let's just dive right into this explainer. Today, we're going to explore how a single, totally invisible number silently monitors, judges, and honestly kind of controls your life in modern America. We are unpacking the psychological trap of consumer credit scoring systems. And as you'll see, what looks like a simple, straightforward math equation is actually this massive, highly effective behavioral control mechanism.
So imagine this. You're looking down at your dark smartphone screen and you see this dangerously low, flashing red number just staring back at you. 548. I mean, it's enough to make your stomach drop, isn't it? When you see a number like that, it doesn't just feel like a random digit. It feels intensely personal. It feels like an indictment.
Because a number like that almost always leads to these exact crushing words. Approval denied. We're not just talking about a math problem here. We're talking about a really powerful gatekeeping mechanism. This one number basically decides your housing, your car, your interest rates, and honestly, sometimes even your job. It's just silently following millions of us through nearly every major life decision, constantly calculating our worth in the background.
Section 1. The three-digit dictator, the birth of financial identity.
Before computerized systems came along, lending decisions were deeply, deeply personal. Banks judged people based on human reputation, local relationships, and their perceived character. You'd literally go sit down with a local banker who actually knew your family, or maybe knew your business. But as consumer capitalism absolutely exploded after World War II, that personal touch, it just couldn't scale. Lenders needed a way to evaluate millions of people, and fast. So enter the cold statistical algorithm, the FICO system. Literally, almost overnight, you were no longer evaluated as a complex human being. You were reduced to a quantified risk profile based entirely on predictive profitability.
Section 2. The behavioral debt trap, the paradox of trust.
Now, logically, you'd probably think the absolute best way to show you're trustworthy with money is to, well, simply not be in debt, right? Wrong. Actually, totally wrong. To prove your financial trustworthiness in this system, you actually have to participate in debt. First, you have to acquire it, then you have to maintain it, and finally, you never truly escape it. You are literally required to keep an ongoing strategic relationship with credit institutions just to exist normally in the modern economy. It is a completely, totally counterintuitive loop.
You're essentially navigating this wild maze of contradictory rules. Just think about it for a second. If you never borrow money, your score stays weak. But if you borrow too aggressively, bam, your score suffers. Let's say you finally pay off that grueling 5-year auto loan. Congratulations, your reward is a temporary drop in your credit score. Or maybe you just want to close an old credit card you haven't used in years. Nope, penalty. You are being conditioned, kind of like a lab rat, through continuous rewards and punishments. It turns everyday personal finance into this really strict daily regimen of self-surveillance.
Section 3. The anxiety economy, managing an invisible reputation.
All of this relentless monitoring, it creates profound psychological exhaustion. Millions of everyday Americans are constantly checking their scores on banking apps, getting these emotional highs and lows exactly like they do on social media. One Reddit user actually hit the nail on the head, calling it credit purgatory. People just feel watched, scored, and completely trapped by these contradictory rules. Even things entirely out of your control, like identity theft, or even positive milestones, like paying off a debt, can feel like this lasting penalty that you just can't shake. It literally turns everyday banking into a source of chronic, low-grade stress.
And what this has ultimately done is fuse our self-worth with our financial metrics. Culturally, we've basically decided that a high score equals responsibility, intelligence, and overall success in adulthood. On the flip side, a low score doesn't just block a loan anymore. It triggers deep shame, social stigma, and this really profound emotional isolation. People actually begin to equate their algorithmic score with their actual identity. We are internalizing a corporate metric as a measure of our inherent human value.
Section 4. The hidden profit engine, the illusion of meritocracy.
So the whole system really parades itself as this objective, perfectly fair measure of responsibility. But if you scratch beneath that polished surface, you find a compounding cycle of structural inequality. You have the high score elites who get all the premium rewards, lower insurance costs, and easy approvals that actively help them build wealth. Meanwhile, the low score citizen, who are very often folks already dealing with unstable incomes or maybe medical debt, they face way higher interest rates and constant systemic strain. So this supposed numerical objectivity actually forces the poorest among us to pay more to borrow, all while framing massive systemic inequalities as deserved personal failures.
And here is the real kicker, a concept called profit scoring. This completely flips the narrative. The system doesn't just ask, will this person repay? Lenders are actively running the numbers on how profitable will this borrower be. The system claims to just reward responsibility, sure, but the hidden truth is that lenders extract the absolute highest profits from the people who revolve their balances, continuously pay interest, and just remain trapped in a perpetual borrowing culture. It's not just about minimizing risk, it's about maximizing prolonged revenue.
Section 5. The surveillance future. You are the data subject. We are moving fast into an era where this system expands way, way beyond traditional lending. We're talking outright surveillance capitalism. Fintech companies are no longer just looking at your payment history, they are actively harvesting your digital footprints. Through AI-based profiling, they're monitoring your spending habits, your online activity, gig economy income, even your streaming subscriptions in real time. Your everyday behavior is constantly being crunched and calculated to predict your future value to the machine. You're not merely a customer anymore. You've become a data subject.
Now, to be fair, is the system entirely evil? Well, not entirely. It genuinely solves real economic problems. It standardizes decisions, evaluates risk at lightning speed, and historically, it really did expand access to lending markets by stripping out a lot of human bias. But we absolutely cannot ignore the human consequence here. The trade-off for all that efficiency is chronic stress, a fused sense of identity, and generational behavioral conditioning. What we essentially have in America right now is a decentralized corporate social credit infrastructure, and it quietly dictates your economic mobility long before you ever step foot inside a bank.
Which brings us to our final and definitely most critical question. As we hurtle toward this future of total behavioral surveillance, we really have to stop and ask ourselves, how much psychological control should financial systems actually have over human life? Does this system genuinely offer us freedom? Or does it just successfully convince us to become better, more compliant participants in our own dependency? Just think about that for a second, the next time you log in to check your score. Thanks so much for joining me for this explainer. See you next time.